Welcome to the Stock Market Palantir channel. Don't miss any new stock insights from us by subscribing to our channel and drop any comments below. Okay, let's get started.
$80.07. That's where the ticker stopped on Friday, January 30th. We were down 6.55% on the session. The volume was heavy, institutional heavy, and the sentiment was, well, it was frankly pretty skittish. If you've been monitoring the forums since that tank rupture news broke on January 21st, you'd think the sky was literally falling.
Short silence. It's ugly. But let's be honest, if you zoom out just a fraction of an inch on that chart, we are looking at a company capitalized at $42.77 billion.
It is a big number.
It's a massive number. We're looking at a stock that has run from $14.71 to nearly $100 in 52 weeks. That is 192% return in a single year. So when you quote me a 6% drop on a Friday, I have to ask the uncomfortable question. Are we looking at a buying opportunity for a future industrial giant, or are we watching the air hiss out of a massive speculative bubble? Because at $42 billion for a company with this specific revenue profile, I'm really struggling to see where the floor is here.
I see why you worry about the valuation. I do. If you look at the raw multiples, it looks like a typo. But this isn't the same company that went public via SPAC years ago. The market is skittish because of a pressure test failure, sure. But the thesis, the reason we're sitting at an $80 share price is that Rocket Lab has fundamentally re-rated. The market has woken up to the fact that they are no longer just a launch company. They are a space prime. They are becoming the backbone of a $1.8 trillion space economy.
Space prime. It's a fantastic marketing term. It sounds authoritative, but we need to strip away the branding and just look at the math.
The math supports the branding. Let's look at the revenue mix.
Fine, let's start there. Because usually when a company pivots their identity, it's because the core business isn't making money.
That's a cynical take, but let's look at the Q3 2025 data. The general public still treats this like a rocket company. They see fire and smoke. But the space systems segment, that's satellites, solar panels, star trackers, reaction wheels, the actual infrastructure of orbit, that segment now makes up 73.7% of their revenue.
Almost 3/4?
Right.
Exactly.
And here is the blinkest takeaway for you. Launch is just the delivery truck. Space systems is the cargo. Launch is low margin, it's competitive, it's dirty, and it's dangerous. Space systems, we are talking 35 to 40% gross margins. They have a backlog of $1.1 billion. That includes that massive $816 million contract from the Space Development Agency, the SDA, for missile tracking. This isn't a speculative maybe anymore. This is national security infrastructure. They aren't just getting things to space, they're building the things that operate in space.
I'm not disputing the quality of the backlog. The SDA contract is a huge win, but I just don't buy that the current price reflects that reality. You mentioned the re-rating. Let's be precise about what that re-rating looks like. As of this weekend, Rocket Lab is trading at a price-to-sales ratio of 82.
High growth commands a premium.
A premium? The sector average is 1.8. You are paying 82 times sales for an industrial manufacturer. That is a valuation that's, it's reserved for high-margin SaaS software companies, businesses that can scale infinitely with zero marginal cost. If I sell a piece of software, it costs me nothing to sell 1 million more copies. But Rocket Lab, building rockets and satellites is capital intensive. It's physics, it is hard, and it is prone to failure. You are paying NVIDIA multiples for a metal-bending business.
It is prone to scarcity. That is the factor you are missing. Who else is there?
We will get to the competition and the elephant in the room in a minute, but stick with the financials. At 82x sales, they are priced for absolute perfection. The market is pricing this stock as if the Neutron rocket is already flying, already profitable, and already stealing market share from SpaceX. But the reality is, they are burning cash.
They're in the valley of death.
Explain that term for the listeners, because it gets thrown around a lot in venture capital.
Well, the valley of death in deep tech is that dangerous period between developing a product and commercializing it at scale. You have massive R&D costs, building the factory, building the rocket, testing the engines, but zero revenue from that product yet. Rocket Lab is dominant in small launch with Electron, sure, but Electron doesn't pay for Neutron. Neutron is a cash incinerator right now. Analysts are projecting a funding gap anywhere from $300 to $500 million before they hit free cash flow positivity in 2027 or 2028.
And that gap is manageable.
Is it? At $80 a share, if anything goes wrong, like, say, a tank rupturing, the air comes out of that balloon very, very fast. And suddenly, raising that $500 million becomes very expensive because you have to issue more shares at a lower price.
Thoughtful pause. You're fixating on the tank. Let's address that head on, because that is the catalyst for this week's drop, January 21st, the Stage 1 tank rupture during hydrostatic pressure testing. The market hears rupture and thinks explosion. They picture a fireball.
In rocketry, a rupture usually means a delay. And delays mean cash burn.
But context matters. For those who aren't aerospace engineers, let's define hydrostatic testing. They fill the tank with inert fluid or gas and they pressurize it beyond flight levels to see when it bursts. The entire philosophy of Peter Beck and his team is fail fast. You push the metal until it breaks on the ground so it doesn't break in orbit with a customer's payload. The report was clear. The launch site in Virginia wasn't damaged. A replacement tank was already in production. This wasn't a design flaw that sends them back to the drawing board for a year. It's part of the process.
That is the optimistic spin.
It's the evidence-based spin. Look at the other catalyst from the same week. The Hungry Hippo fairing arrived at Wallops Island. It cleared its own qualification testing. They are moving hardware to the pad. This isn't vaporware.
It's not vaporware, I agree. Neutron is real, but it is complex. We are talking about a medium-lift, reusable vehicle. It's exponentially harder than the Electron. It lands propulsively. My concern is that at this valuation, the market is assuming the launch schedule is written in stone. You mentioned the fail-fast philosophy. That's admirable engineering, but it is terrible for short-term stock stability when you're trading at 82 times sales. If Neutron slips from the first half of 2026 to late 2026, or, God forbid, 2027, that dilution risk I mentioned becomes a certainty. They will have to sell stock to keep the lights on.
I'm not convinced by that line of reasoning because it ignores the capital environment. I mean, even if they need to raise capital, doing so at a $40 billion valuation is very different than doing it at $4 billion. But let's look at why they command that premium. It's the space prime thesis, yes, but it's also the competitive vacuum. You can't talk about Rocket Lab without talking about the monopoly.
SpaceX.
Exactly.
And that is the biggest threat to your thesis. The rumors are swirling that SpaceX is preparing for a $1.5 trillion IPO.
Which validates the sector.
Or it crushes the competition. Think about it. SpaceX has the Falcon 9. It is the most reliable machine in history. They have economies of scale that Rocket Lab can only dream of. If SpaceX decides to lower the price of a Falcon 9 launch to protect their market share, they can crush Neutron's margins before it even flies. Rocket Lab is targeting 40 to 50% margins on Neutron. SpaceX can afford to run leaner than that just to starve a competitor. And let's not forget, Rocket Lab is trying to sell assured access to space. SpaceX is access to space.
That is exactly the point. The government, the SDA, the commercial constellations, they cannot rely on a monopoly. This is the second source doctrine. The Pentagon does not want to be beholden to one provider, especially not one controlled by, let's just say, a volatile personality. The market needs a non-SpaceX option. And who is left? Look at the peers. Astra's fighting for survival, delisting notices flying around, ULA is struggling with cadence on the Vulcan, Blue Origin is making progress with New Glenn, sure, but they are focused on heavy lift and are still largely unproven in orbit. Rocket Lab is the only one executing high-frequency launch right now.
High frequency is a strong turn for Electron compared to Falcon. SpaceX launches every few days.
They just launched Bridging the Swarm on Friday. Launch number 81. That was only 8 days after the previous launch. That is operational maturity. That is why customers are willing to pay. They aren't buying a paper rocket. They are buying a slot from a company that just put a KIST satellite into orbit like clockwork. The SpaceX IPO sets a ceiling, a valuation benchmark. If SpaceX is worth $1.5 trillion, is it so crazy that the number 2 player, the only viable alternative, is worth 3% of that?
Short sentiments. It's a compelling argument, framing it as an insurance policy against a monopoly. I get that. But even if I grant you the operational success, which is real, I respect the engineering, I have to look at the behavior of the people running the company.
You mean the insider selling?
I do. We have to talk about Sir Peter Beck.
Sir Peter, knighted in 2024. A well-deserved honor. He's a visionary. But in December 2025, just 2 months ago, he sold 2.5 million shares. That is $141 million off the table. Adam Spice, the CFO, sold. Frank Klein, the COO, sold. If the future is so bright, if we're on the verge of the space prime era where they control the orbital economy, why is leadership cashing out nearly $150 million right before the biggest product launch in company history?
That is a classic bear trap. You look at the transaction tape and you see panic. But you know as well as I do that these were Rule 10b5-1 plans.
Explain that for the listener because it sounds like jargon. A 10b5-1 plan is a pre-scheduled trading plan. Executives set them up months or even years in advance to avoid accusations of insider trading. They say, on this date, sell this many shares, regardless of the price or the news. This wasn't panic selling based on the tank test. This is compensation management. Peter Beck is a tool and die maker. He built this company from nothing. He still owns nearly 10% of the company. It's perfectly rational for a founder to diversify slightly after locking up his entire net worth for 2 decades.
I agree that diversification is rational, but the scale of it matters. $140 million is a massive amount of diversification. It suggests, at the very least, that he thinks the stock price in December was a pretty good deal, perhaps fully valued.
Or that he has tax bills and a life to live. And look at who is on the other side of those trades. Vanguard owns 7.8%, BlackRock owns 5.8%. Institutional trust is actually increasing. They aren't scared by a scheduled sale. They're looking at the backlog.
Institutional money follows momentum until it doesn't. And while I respect Beck, he's not a tech bro, he's a genuine engineer. The discipline of audacity has to meet financial reality.
Let's bring this down to the ground. We've talked billions and trillions. Let's talk about $5,000.
Okay, practical application.
If a listener puts $5,000 into Rocket Lab today at $80 a share, what actually happens to that money? Let's break it down by time frame, looking at the risk profile.
I'll take the bear side of this trade, obviously.
Short term, 6 to 12 months. We're looking at the Neutron debut.
Right. The risk here is binary. It's a coin flip. If Neutron launches and fails, or if it is delayed significantly into late 2026, the technical support at $75 won't hold. The narrative breaks. We're looking at a drop back to $55, maybe lower. Your $5,000 investment shrinks to $3,500. That is a 30% haircut very quickly, and that hurts.
I see that risk, but the bull case is that Neutron flies. The market risks the medium lift Jesus. Suddenly, Rocket Lab isn't a small cap player anymore. They are a major industrial. The price targets from Bank of America go up to $120. That $5,000 becomes $7,500. That's a 50% gain in a year. You don't get that in an index fund.
That's gambling, not investing. You are betting on a maiden flight of a complex vehicle. Let's look at the midterm, 2 to 4 years.
This is where the valley of death ends. By 2027 or 2028, analysts expect them to be GAAP profitable. Revenue hits $1.2 billion.
Wait, pause on that. $1.2 billion in revenue. If the stock price stays exactly where it is today, $42 billion market cap, that is still trading at 35 times future sales. For the stock to double, for your investment to go to $10,000, you need valuations to stay at these astronomical levels, or you need earnings to explode.
And they will. Because once Neutron is flying, the capex drops. They stop building the factory and start running the factory. The margins expand. If the PE normalizes to something like 30x on 2028 earnings, doubling your money is a very realistic path.
A 30x PE is reasonable.
but getting there requires flawless execution. No more tank ruptures, no launch failures.
And then there's the long term, 2030 and beyond, the space prime thesis.
The blue sky scenario.
Revenue at $6 billion. They aren't just launching satellites, they are running them. This is space as a service. They sell the data, not the rocket. Margins look like software, around 15% net.
15% net margins in aerospace is historically incredibly difficult. Boeing didn't do it. Lockheed doesn't do it.
But they aren't vertically integrated like this. If Rocket Lab hits that and the market gives them a platform multiple, we could be looking at $240 a share. Your $5,000 triples to $15,000. That is the power of compounding growth in a new industrial sector.
Thoughtful pause. You know, I come at it from a different way. You're assuming software-like margins for a company that bends metal and deals with gravity. I just don't see the path to 15% net margins when you have SpaceX breathing down your neck, likely driving prices down to compete. To get to that 2030 number, everything has to go right. The economy, the tech, the competition.
But that's the nature of growth investing. You are buying the future. You're buying the railroads of the 21st century before the tracks are laid.
I prefer to buy the future at a reasonable price. Which brings us to the conclusion.
Go ahead. Give us your verdict.
Look, Rocket Lab is a great company. Peter Beck is a legend. But $80? It's a terrible price. The technicals are screaming caution. We have a MACD sell signal. We have a pivot top. The smart money waits. I'd want to see a pullback to the $75 support level, or even better, wait until we know how they are going to bridge that funding gap. There is too much risk baked into this cake right now. You can love the company and hate the stock.
I see why you'd want to wait. It's safer. But safe doesn't get you 192% returns in a year. My perspective is that this is a structural transformation of the global economy. Rocket Lab is building the railroad tracks, the trains, and the cargo. You don't try to time the dip on a company that is becoming the second most important aerospace firm in the world. Volatility is just the price of admission.
And sometimes, volatility is the market telling you that you've gotten ahead of yourself.
Or that the market is just catching up to the vision.
Short silence. Well, the market opens in a few hours. We'll see what the tank rupture news has left in the tank.
Indeed we will.
If you like this video and want to watch more content like this, then hit the subscribe button. It's totally free. Thanks for watching and see you in the next video.